What if I told you there's a simple yet life-changing strategy to grow your wealth? No lottery tickets, no risky investments, just a shift in how you manage your money. It all starts with paying yourself first. This isn't just another budgeting tip, it's the cornerstone of real financial success. Stay tuned, because this one simple practice could be the key to your financial independence. The concept, paying yourself first, simplified. The approach of paying yourself first stands out as a core principle in personal finance. By prioritizing savings before tackling any other expenses, you actively shift your financial mindset from reactive to proactive. This method aligns with findings from financial behavior studies showing that when savings become a regular and anticipated expense, people are more likely to stay consistent and motivated. A survey by the National Financial Health Institute found that 65% of individuals who adopted this practice reported significant growth in their savings over 3 years. The concept essentially places future you as a priority over present wants. It serves as a reminder that safeguarding your future shouldn't hinge on leftover funds, but should be the first allocation of each paycheck. Why this works? Behavioral magic. The psychological advantage of paying yourself first cannot be understated. It's an effortless nudge towards financial discipline, leveraging the power of habit loops. Behavioral scientists emphasize how automating savings removes the friction of decision-making, reinforcing positive money habits over time. A study from Behavioral Economics Quarterly demonstrated that individuals who used automatic savings tools were 40% more likely to meet their long-term financial goals than those who tried to save manually. This is because automated savings foster a set-it-and-forget-it mindset, reducing the temptation to spend on non-essentials. Over time, these small, consistent actions accumulate into a significant safety net, illustrating the power of incremental change. Building an emergency fund, a lifesaver. Emergency funds act as an essential buffer during life's unpredictable moments, reducing stress and preventing financial derailment. The Financial Preparedness Report highlighted that households with an emergency fund covering at least 3 months' expenses were 55% more likely to recover quickly from financial shocks compared to those without any savings. This reserve can cover unexpected situations like medical bills or urgent home repairs, ensuring that life's hiccups don't lead to debt. Additionally, having such a fund in place can offer peace of mind, allowing people to make better financial decisions without the pressure of living paycheck to paycheck. The data consistently proves that the financial well-being stemming from an emergency fund is an invaluable asset to mental and economic stability. The power of automation. Set it and forget it. Setting up automatic transfers is a game changer for personal finance. Fintech solutions saw an uptick in automated savings tools, simplifying the process for users across all income levels. Platforms like Acorns and Digit reported a 20% increase in user retention attributed to their automation features, proving that convenience translates into habit formation. Automation helps bypass the temptation to allocate savings elsewhere by making it a preemptive decision. Imagine your paycheck being split the moment it lands: 10% into savings, 5% into retirement. What remains becomes your actual spending money, ensuring that the fundamental step of saving is already taken care of. This practice is proven to align with the core principles of behavioral economics, making the path to better choices as seamless as possible. Compound growth, your secret wealth multiplier. Compound interest is a wealth-building force that Albert Einstein famously called the eighth wonder of the world. The average return on diversified mutual funds hovered around 7%, underscoring the importance of investing saved money. For example, someone starting at 25 and investing $200 a month at this rate could see their funds grow beyond $250,000 by age 55, an outcome possible due to the effect of compounding. The magic lies in returns generating their own returns. This means the earlier you start, the more exponential your savings can become. Even starting small can create meaningful growth over time, transforming modest deposits into substantial wealth with minimal active effort. Prioritizing future goals, from vacations to retirement. Having separate savings allocations for specific goals makes future planning tangible and less daunting. Data revealed that 45% of millennials and Gen Zers were more motivated to save when they designated funds for personal milestones, such as weddings or home purchases. This approach not only prepares you for significant life expenses without debt, but also instills a forward-thinking mindset. Labeling savings accounts, whether it's summer 2025 vacation or first home fund, adds a motivational touch that reinforces the purpose behind each dollar saved. This technique integrates personal aspirations into the discipline of budgeting, making the process more relatable and achievable. Avoiding lifestyle inflation. As incomes rise, so does the temptation to upgrade one's lifestyle, leading to a pattern known as lifestyle inflation. However, paying yourself first acts as a safeguard against this tendency. Economic data pointed out that individuals who saved an incremental percentage of each salary increase maintained more stable net worth growth than those who let their expenses rise accordingly. This practice keeps financial goals intact and minimizes the risk of living paycheck to paycheck despite earning more. It reinforces the principle that true wealth comes from assets growing faster than expenses, a lesson often emphasized by financial experts. Reducing debt reliance. The financial stability that comes from maintaining an emergency fund cannot be overstated, particularly in times of crisis. This fund helps to break the reliance on high-interest loans and credit cards, which often come with interest rates as high as 20 to 25% annually. Such debt, when accumulated, can create a cycle that's difficult to escape due to the high costs associated with compounding interest. The 2024 Consumer Debt Report highlighted that individuals with emergency funds were 35% less likely to resort to credit during financial challenges, reducing their risk of long-term financial strain. Beyond saving money on interest payments, these individuals experienced improved credit scores due to reduced credit utilization. This proactive approach to financial preparedness preserves not only immediate financial health, but also safeguards future borrowing potential by preventing unnecessary debt. Ultimately, paying yourself first ensures that you have a financial buffer to weather unexpected expenses without falling into the common debt trap, which can erode financial stability over time. Real-life testimonies. Ordinary people, extraordinary results. Hearing real stories of financial transformation provides motivation and proof that paying yourself first is more than just a theory, it's a practical, life-changing strategy. Consider Dave, a middle-income manager who started saving 15% of his income into a diversified account in 2019. Dave not only accumulated a robust safety net, but also saved enough to fund his long-held dream of opening a bakery. His story is echoed by many others. Small, consistent actions compounded over time lead to significant financial milestones. Similarly, a survey conducted in 2024 found that 60% of respondents who adopted this method reported improvements in their quality of life, including reduced stress and the ability to pursue personal goals without financial constraints. These examples illustrate that you don't need to be wealthy to start. Commitment and consistency are the most important factors. This method shows that a pathway to financial security is accessible for everyone willing to take that initial step toward prioritizing their future. Long-term financial security. The pinnacle of paying yourself first is the long-term security it provides. The Financial Stability Index revealed that 70% of participants who consistently applied this strategy felt better prepared for retirement compared to their counterparts who saved irregularly. These individuals reported enhanced peace of mind, knowing they were prepared for life's uncertainties, from economic downturns to personal emergencies. This financial foresight fosters a sense of control and confidence, allowing people to face the future with fewer worries. Additionally, paying yourself first bridges the gap between today's earnings and tomorrow's needs, creating a safety net that protects against the unpredictability of job markets and economic conditions. By embedding savings into your lifestyle as a non-negotiable expense, you build a foundation that supports lifelong financial health. This principle, simple as it may seem, becomes a cornerstone of financial freedom, empowering you to approach life with greater assurance and security. Mastering the habit of paying yourself first is more than just a financial tip. It's a mindset shift that sets the foundation for lifelong security and wealth. By prioritizing your future over fleeting expenses today, you take control of your financial destiny, ready to transform your savings and secure your future. Start small, stay consistent, and watch how the power of this principle shapes your path to prosperity. If you found this video helpful, don't forget to hit that like button. Subscribe to our channel for more actionable financial tips. Your future self will thank you.